This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of the show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Iruretagoyena, Senior Associate at the Impact Engine. Impact Engine is a women-led and owned Chicago-based venture capital and private equity firm investing in companies driving positive impact in education, economic empowerment, health, and environmental sustainability. Ander, thank you for joining us.
Oh, thanks so much for having me. Really happy to be here.
Great. So tell us about your background before investing in early stage companies.
Yeah, so to give you a quick intro on my background, so I'm originally from Mexico, but have finished up growing up here in the US and went to college here. Right out of college, I went into the world of investment banking. I was both at Morgan Stanley and Bank of America, originally working in Latin America mergers and acquisitions from New York. But then I started focusing on equity capital markets in my associate years. I was there for a total of 3.5 years. And even though it's a great place to sort of start a career, figured that wasn't really something that I was really truly passionate. And so wanted to pivot to something else. So I used two things to pivot to the world of impact investing, which is where I'm currently at. I used my MBA, which I just graduated last year from Chicago Booth. And I also spent 1.5 years working with the Bill and Melinda Gates Foundation, working in financial inclusion strategies to find myself here in this new role.
Great. So what excites you right now?
Yeah, it's funny you should ask that, Paul. Here in Impact Engine, we have a tradition that every year during Thanksgiving and the holidays, we like to do a blog post about why we're optimistic. And so, it's a great time to ask that question. One of the things that really excited me was one of our newest investments, which is a company called Work It Health. Now, Work It Health was really special for me because in my transition of going from investment banking to impact investing, I was really looking to have a lot more meaning in the work that I was doing. And, this particular year in COVID, with all the ups and downs, one of the biggest downs that I had was that a very close family member was struggling with addiction. And with our investment in Work in Health, I found a way to sort of really tie what I was going through and my emotions to a potential solution and an improvement in the space. And it just shows the difference of, having a sort of working in the services industry and working on fixing footnotes of a 200-page deck versus sort of investing and helping drive growth in innovative companies. To give you a little bit of background on Work at Health, if in case you're not familiar with it, they're a virtual addiction treatment platform, but really geared towards a focus of efficacy and effectiveness. Their whole thesis in being is that currently the market for treatment services, you can either sort of go to your traditional Alcoholics Anonymous, things like that are effective, but they're effective in, call it, the 30% range. Or you could go to the expensive centers that require you for sort of like press just pause in your life for 1, 2, 3 months, and you have to pay out of pocket. And so what's really exciting about Work at Health is that they're bringing the advent of telemedicine and telehealth to deliver an addiction treatment that has effectiveness rates of calling the 70% rates, which is unheard of in the industry. And so it's really, really awesome to hear that now this option is not only available for everyone due to the virtual nature of it, but that they built this business with a real purposeful intention of efficacy, but also in sort of building a business model really close to payers and making sure that it's a reimbursable cost. And we sort of think that that's going to be the difference and what makes this company succeed above all others.
That's great. So you see a lot of startups out there and investors. What's your advice for people investing in startups in the impact sector? What do you tell them to do before they write that check?
I think in our industry, a lot of people get hung up on the metrics and just this focus about always trying to measure and making sure you have the data to back it up. And there's a lot of scrutiny on that. And some of it is rightfully so, but I think at times it can be overdone. And if you focus just in the minute details, you end up missing on the overall picture. So if you're an investor in the impact space, I would challenge you to, rather than focusing on what's a specific metric, what's specific data, to focus a little bit more on the thesis of the company and sort of the nature of it. And if you do that job correctly, the metrics themselves will come very easily. Right? For instance, an example I just talked about in WorkIt, our impact metric is directly tied to their competitive advantage. And so it would be really strange for them to not be measuring those metrics that speak to their efficacy, that speak to their coverage, that speak to the reimbursement rate, if that's not sort of tied to the business, right? And so it's sort of what can be a very daunting conversation as to how you measure the impact you're creating in your investments. It suddenly turns it into a very simple conversation. So I would urge investors to think of it in that lens.
Great. And then on the other side of that table, what's your advice for founders raising funding? What do you tell them to do before they go out to launch that campaign?
Yeah. Before you sort of, right, if you're a company raising funds in this space and you're pitching to an impact investor, it used to be that, right, impact investing, you sort of had a lens of it having to be a concessionary investment. That if you're positioning yourself as a impact company or as a social enterprise, you're not necessarily a market rate company. And so I would really, if you're a company investing in the space and you want to pitch to impact investors, I would first of all know that, at least in the case of Impact Engine, and I hope others in this space, we take the view that impact is not concessionary, and we're going to hold you to the same sort of level and rigor of being a viable business model. And so to be prepared to not only be able to say the impact we're having, but really sort of connect the dots to us and show us how, because you're having impact, you're having a competitive edge out there. And if you can prove that, then it becomes a much more compelling opportunity.
Great. Well, let's talk about the state of impact investing. How do you see the industry evolving from here?
Yeah, I mean, it's interesting. And I think we have a little bit of a unique view in it because at Impact Engine, we're not only investing in companies, but we also invest in funds. And, it used to be that you could count the number of market rate pure play impact investing firms in the palm of your hand. But right now, I mean, obviously there's clear gaps, especially at the growth stage, but it's good to see momentum and more firms evolving there. And so as being sort of an investor in funds also, you get to sort of start being able to not just apply goalposts and sort of invest in the companies that need them, but really sort of now you have a menu of firms that you can stack up against each other and even have more conviction on the ones that you invest in. And so you'll have, I think, how you'll appreciate this, right? In venture capital, when you're diligencing a company, you see some really aggressive hockey stick revenue projections. And you know that the path to get to those numbers, it won't be easy and there's going to be delays and it's going to be messy. And you're probably, right, if you're a good investor, you're going to take those projections with a grain of salt. Well, in the case of impact investing, in 2011, when it was just on the verge of becoming an industry and a word and something, Impact Engine ourselves, we were founded in 2012. In 2011, there was a study by the JP Morgan, the Rockefeller Foundation, and the Global Impact Investing Network, otherwise known as GIN, who published a report claiming that impact investing would reach in total in assets under management would reach anywhere between $400 billion and $1 trillion by the year of 2020. Well, just this past year alone, the IFC just published a report that puts that figure above $2.1 trillion. So it was great to sort of see the industry surpass that figure, and sort of it speaks to the momentum that there is.
Great. And so what do you think is the biggest change we'll see in impact investing in the next 12 to 24 months?
Yeah, the biggest change, it will sort of have to be, I think, in the impact measurement and management space. Nowadays, it's really hard to see any startup pitch that does not have at least a ESG slide that sort of speaks to how they're thinking about managing their own footprint. Private equity firms can't go and raise money from pensions or LPs without having sort of a ESG policy in place, a D&I policy in place. And right now we're in a weird mix of people knowing it's important, but there not being a standardized standard in the market. And so I think that's a problem that's going to have to be addressed and solved. And there's starting to be some convergence in things like the SASB standards and things like that. But I think in the next 18 to 24 months, you'll sort of see a big push to try to clear that uncertainty up.
Great. Well, let's talk about your investment thesis. It's in the impact sector, but can you give us more detail about what your criteria is?
Yeah, I mean, right, in Impact Engine, we're generalists. We invest across 3 different sectors. We invest in environmental sustainability, health equity, and economic opportunity. And our real edge in sort of investing in these is to be experts in impact, to be experts not only in the measure and management of it, but in helping companies guide through certifications, through narratives, through our stories, and really to sort of be a voice that helps the company sort of tell their story and be like, hey, we took it to the next level, that in our own cap table, we have people that validate our mission and the impact that we're creating here. And so our main investment thesis is exactly that companies who are intentional in the impact they're creating in the long run are going to overperform companies that do not. I'll give you an example of this that perfectly illustrates sort of what we're about. Another one of our portfolio companies is a company called Posigen. Posigen focuses on doing solar energy in the rooftops of homes, but really with an eye towards lower and middle income households. And that's really different and differentiated in the market because traditionally solar rooftops are sort of more for the solar cities of the world, the higher income houses, the homes in Vail in Park City, the ones that sort of cater to have a Tesla out in their driveway. And the reason why that's happened is because usually in order to install a solar panel in your roof, you really need a lot of financial underwriting to go behind it, right? You're usually leasing that product and it's a 20-year lease, and then you're selling part of the energy you generate back to the grid. But in the case of Posigen, they're doing all that financing, but to the LMI community. And so there's a very significant sort of risk in sort of providing that type of service to that community. But they built a company that is from that community. The people they employ, the leadership sort of comes from there. And they've sort of figured out someone that nobody else has been able to, which is how to cater to that community. And they're getting people with credit scores in the 500s and 600s, behaving like people in the 700s and 800s, and having those same repayment rates. And sort of, we really think because they're being so intentional, and that's a clear aspect of their differentiation, that this is why they're sort of having the growth they're having.
Great. Well, let's talk about the challenges in this space. What do you see as the main challenge your startup space in today's market?
Yeah. I mean, the challenge, and I think we talked about this a little, it's sort of there will there will have to be a little bit more definition of sort of and differentiation between being a social enterprise and a valuable business model that is sort of right for impact investing capital, and sort of a little bit more distinction between what philanthropy is and what impact investing is. And in the middle of that, you have to sort of navigate the world of very confusing reporting and how you sort of help startups have the data to back up their mission intentionality, but at the same time, right, they're scrappy teams, they have a million things going on, they're trying to scale a business, and sort of how do you help them and support them in sort of having those metrics, but without it getting in the way of doing and running a business.
Great. Then what do you think is the main challenge investors face in today's market?
Yeah. I mean, I think it's greenwashing is a big challenge in the space for sure. I feel like there will definitely be a reckoning that will come when there's a little bit more of a standard and definition across the market. People also got to understand the distinction between ESG and impact. ESG, here at Impact Engine, ESG, we like to think ESG is more about how you manage risks versus impact is sort of the actual outcomes you're creating. People also have to understand that just because, for instance, you're a private equity firm investing in education and healthcare, that in and of itself doesn't make you an impact investing firm. You have to take it to the next level and really be focused on the outcomes and the quality of the products that you're delivering. You also, emerging managers are trying to establish their own impact investing firms, right? And we talked about it a little bit. You're fighting legacies of where people see, oh, you're raising an impact investing fund. Oh, so I'll put you in a different bucket because you're going to be below market rate returns. But that's not the case. And then lastly, it's a new industry that has a lot of momentum, but it's a new industry that's going to have a lot of emerging people in it, and the people that are come to it don't necessarily have the establishment or the track record sort of being in it, and so there's going to be a sort of hurdle of having to overcome that, I think.
Great. Well, there are many sectors and applications in the impact investing space. If you had to pick one or two that are good immediate opportunities to pursue, what would you call out?
Yeah, right. So as I mentioned, we invest in three main ones: economic opportunity, environmental sustainability, and health equity. I'll talk about the one that I know the most of, which is economic opportunity. As impact investors, our ultimate mission is to invest in those companies whose products positively impact the life of people here on the planet. And one of the main ways we can achieve that is by focusing on the needs of economic stability and mobility while investing in the necessary tools needed to achieve them. Now, we know that these tools, they're not equitably distributed among society, and that they span a lot of different sectors, right? If you sort of break into economic opportunity, you're looking at things within edtech, fintech, affordable housing, poverty alleviation, diversity movements. And so when we look at that universe, we've chosen to focus on the most pressing subsectors and the ones where we think there's a clear path to improved outcomes, and those outcomes can be rigorously demonstrated. So we focused on four different things. The first one has to do with hourly and gig workers, who across the US, there's over 82 million workers who are paid an hourly wage for their service. You're talking about close to 60% of the US labor force. And out of those workers, fewer than 2 in 10 have enough savings to pay for an unexpected $1,000 expense. And so we seek to invest in companies reshaping how hourly and gig workers are managed, how they're paid, and the career prospects that are offered to them. Another subsector that we like is upskilling. With advent of the digital economy and all the advancements in technology, we want to sort of focus on companies that help keep up with the rapid pace of change and help workers learn the skills and competencies that are required for the new jobs, versus sort of falling victim to the widening skill gap that's already present. Currently, a recent survey found that nearly 60% of U.S. employers have job openings that stay vacant for 12 weeks or longer, really sort of speaking to that skill gap we have in this country. And then the last two sectors that we're focusing on, one is on digital financial services that really build security and prosperity for individuals, but without sort of having unchecked proliferation that can be extremely detrimental and predatory. And then lastly is student success, which we know is an important gateway to economic opportunity and a way for individuals to get the skills they need to live up to their potential. And we like to take a holistic approach to the life of the student rather than just focusing on a specific period of time versus just early education. And so we invest in companies really looking to improve the education system and who can tie their product or service to enhance life outcomes such as employment, increased wages, or reduction in poverty rates.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I'm curious how I would love to actually, as an outsider to the industry of impact investing, and having seen that you've had over 700 people like me come, what is your take in this sort of momentum and in the industry?
I think it's growing. I think impact investing every year includes more and more or greater percentage of the startups. There's a shift from nonprofit to impact companies, and I think we're seeing that in the numbers itself. I see the financial industry getting involved as well. There's an effort to try to standardize what is impact and how can you measure it. I've heard many financial groups talk about, well, if you meet your impact goals, we'll decrease your interest rate by 2%. If you don't meet your goals, we'll increase your interest rate by 2%. And so I see more and more groups coming together to put more effort behind the impact effort, because I think in some years from now, you're going to not be able to just run a business for profit. You're going to have to be able to provide something back to the community in addition to a profit. So I think that's where it's going. I don't know how fast it will get there, but I do see it increasing every year, the number of companies that are impact and are starting to measure that impact too.
Couldn't agree more. Music to my ears.
Okay. Well, good. Well, appreciate your sharing that with us today. So how best for listeners to get back in touch with you?
Yeah, listeners can always get in touch with us and learn more by visiting our website at theimpactengine.com. In there, you'll find the contact form. We always have an open door policy to anyone interested in impact. Please fill it out and we'll make sure to respond right away. If you're a specific company, which you think you might be a good fit for either our venture strategy, where we're investing in seed and Series A companies, you can reach us at directs@theimpactengine.com. Or if you're a group of people trying to raise together a fund and you have a strategy that you think might be a good fit for us, you can always reach us at funds@theimpactengine.com.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
For sure. Thanks so much, Paul.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.